Hello, everyone, and welcome back to the Antivalvo report. We're going to continue with the following section, which touches on portfolio construction. And basically, we discussed earlier the idea of false diversification, whether it's particularly acute during hostile markets, as well as the melt-up we're currently going through. The question here is, as I discussed, how to build a portfolio subject to two key dimensions. The first one being having a balanced portfolio in terms of risk on versus risk off, with the so-called strikers, midfielders, defenders, goalkeepers. And the second dimension being inflation, which I think it's going to be a dominant driver of global markets for the foreseeable future, possibly the exit of this situation we're in, as bubbles are too big to fail, in my opinion, and likely central banks will be able to hike, as we discussed in other sections. With that, the big losers are going to be strategies that are short inflation, such as cash or fixed income or credit. And as a result of that, one of the consequences is how fixed income has lost, in a way, part of its defending power, particularly in places like Europe, where already nominal rates are negative. The treasury market has more defensive power. But the issue here is how to create a team based on behavior, not labels. And this is critical. It's a dramatic change from asset allocation to behavior allocation. And to do that, well, we aim to basically create a strategy that will defend. And in that sense, when you think about the different factors, we create this avatar, which it's a way to show graphically the attributes of a given strategy. And in this case, you see the spider analysis showing very strong performance during volatile events and risk off, and bad or very average during more benign markets. So the idea is to create a team to combine the players. And this example is very simple. It's a 50-50 portfolio of S&P and Igneo, and we see very clearly the negative correlation and how ultimately the team is done well. If you think about the contribution of the goalkeeper Igneo in this case, we see how pretty much by construction the strong performance that has come during adverse markets when the team needed it most. As a result of that, you end up with a 50-50 basket that, if you just leave it passive, it'd be the weighted average of the two. But there's an element very important, which I think is rebalancing the portfolio, the compounding effect, which effectively looks to buy cheap, sell high, buy cheap. And this enables us to get some incremental returns. Obviously, there's no pure magic formula or perfect timing, because it's going to be impossible to always or find the ideal moment, but do it in a systematic basis. We believe embraces volatility and adds value. With that, beyond that application, you could take this further with a strategy, be slightly more aggressive, having an 80% in equities. So if your starting point was 100% in equities, bring it down to 80, and use the other 20 to invest in anti-bubbles. And this would give you implied leverage or direct leverage of 160%, but obviously very reliant on correlations holding, which is something we aspire to do, but is not guaranteed. So this strategy is approved. We are still basically looking for gather sufficient funding to launch it. I know some of you are waiting for that to take place. If anybody's interested in discussing further as an alternative to equity replacement, please let us know. With that, I will conclude this brief session and move on to the next one, if you're interested, which is on the energy sector, discussing in detail one of the big risks that I believe is currently in the system, which is the potential for much higher energy prices. Thank you, and speak soon.